Hey everyone, it's Jeff McGinnis at CrossCountry Mortgage, and it is the October Rate Watch Report. I'm excited about October, and you can tell it's October because I have my Alpha Dad vest on, and I'm giving out high fives at the football games, and I'm enjoying October. I'm also excited that it's Halloween, and most of you, if you know me, my jam is Halloween. I can't wait to get the decor out. It's always a great season for me. Hopefully you're enjoying your October as well. And I've got some things to talk about. Rates have increased over the last month. There's some why behind it. And per usual, I'll go through the charts, let you see the trends for yourself, and then also talk about inflation, what the Fed is wanting and needing for what they think will help the economy, and then go through unemployment, because inflation and jobs are the two things that we need to be paying attention to see which direction the rates will head. I'm going to head to the chart. So team, here is the bond chart. And in rate watches past, I've explained to you that down is bad or red is bad for rates, and green is good or good for rates. As you can see, we've had a lot of red over the last month. As a matter of fact, if we're looking at September 5th to the time of this recording, September 29th, it's kind of been a rough go. We've seen a lot of downward momentum with the bond charts, which means that rates have definitely increased. And if we take a look even over the last year, dang, it's about the lowest this bond chart has been since the last year. So we got basically nowhere to go but up at this point. So team, as we go through time and space, we're thinking that the bond is actually oversold right now, and we should be seeing a buying trend and maybe a bit more evening out of an increase in the bond charts, and therefore a reduction in rates. So what we want to take a look at next is what the Fed wants. So the Fed wants to see the PCE. They like to look at the personal consumption expenditure index. And I will take a look at this with you. That is the measure of inflation that they want to see. So let's take a look. So here's the United States core PCE price index over the last year. And as you can see, the trend is definitely downward. And when, it's been a while, but we haven't seen a 3 in front of that number for a while. So this is really good news, because this is what the Fed is looking for. We're a little bit further out than the 2% that they're looking for, but the trend is quite significant. So they're going to more than likely pause out on this next Fed meeting, from what I understand and what I've been reading, but they're going to be paying attention to that core PCE index as their measure of inflation. Then we need to be looking at the other component that the Fed's watching, which is unemployment. And what they're looking to do is make sure that the unemployment is right-sized. And as a person that studied economics, what I was taught was that a full inflation was 5% unemployment. And when we look at the charts, you'll see what it actually is. So let's go there now. So in our chart, the United States unemployment rate is now at 3.8%. We're a little bit further out from what most would consider full employment. We're actually below that, which means that the economy might be still a little bit heated. So that's what the Fed wants to be seeing, is just a right sizing of the economy so that there's not an overabundance of inflation. So they want inflation to be at 2%. They want to make sure that the employment rate isn't too high or too low, and that's what we can be paying attention to with rate trends moving forward. The good news is houses are selling. People are getting into contract. They're getting into their homes and their dream homes, despite the rate challenges. And a lot of what we're doing on the McGinnis team is helping people with understanding what the facts are about rates, what typically happens historically over business cycles, and then giving them tools to work with to manage cash flow, to make sure that they're qualified and they can afford their payment without being, house poor. So if you've got somebody that may be saying, gosh, the rates are too high, I can't buy a house, perhaps they need to have a conversation with me to talk through when it is right for them. And perhaps it's not because of a number of things, but at least they would know what milestone they need to make after having chatted with me. So I'm here to help. I'm committed to helping you. If you happen to be a real estate professional, your clients, if you're seeing me online for the first time, I'm here to help you figure out when is the right time to buy. So feel free to connect with me, call, text, email. It's in the YouTube page. Also, if you like this video, please do like it, and look forward to talking with you soon. Have a great one. Take care.